Stefan, in a nutshell, tell us what dynamic actuarial modeling is and what problems it aims to solve.
Yep, gladly. So, actuarial modeling is all about a pricing process driven from the data to the final application of the models that you have selected. So basically it starts by gathering as much as possible data describing the claims, describing the insurance undertakers, gathering that data, standardizing it, cleaning it, and potentially also add unknown values. Then you divide your data set into at least two different parts, a part on which you basically train your model and a part which you will use later on to test if the model also accurately predicts what has not been trained. You apply techniques typically on frequency and severity of claims. So there is a whole lot of possibilities there. Mostly these days, companies still stick with generalized linear models, GAM models, but more and more we see that machine learning techniques are also be added to that possibilities. You compare the model, you test the model, you backtest the model, and then you put that model into a library where it comes together with other models. So you build up, so to say, over time, all of your best models. At one point in time, then, you apply, while you're backtesting, for instance, you apply that model to the other data set that you have set apart in the very beginning, right? And then the biggest challenge that companies have is, how do I put that into production? So is there an easy way, is there a fast way to put that into production? And that is part of the process that is sometimes, in fact, taking most of the time. So we automate that part as well. We help you in deciding which companies or which individual insured people to accept by also allowing you to put underwriting rules in it, right? Because it can very well be that you have a model that predicts and gives a score to everybody, but you have decided as a company not to go into the very young drivers, for instance, right? Or stay away from very old drivers. So all of that are underwriting rules that you need to apply. And then finally, you put that into production and you start scoring people. Now, it doesn't finish there, because at the end of the year, usually you have to re-evaluate what the new price will be of a contract. Most contracts are yearly contracts, right? So you have given your customer a price, but what price will I give him for the second year? Did he behave as a good driver? Can I basically reward him? Or did he behave like a real bad customer and I have to punish him in a way? And in that optimization process, I can decide which customer base I want to keep and which one I want to get rid of.
Excellent. Neil, in your view, what recent advancements in terms of insurance technologies or revenue models are driving the adoption of dynamic actuarial modeling?
Yeah, so globally, I think there are changes in the insurance industry, right? If you look at, in general, for the big market segments, microfinance is making a comeback. So previously, a particular market that was called undeserved market because of the overhead that it used to create, we are now seeing a change that technology is able to reduce that cost of operations, thereby making it viable to offer products in this segment of the market. However, the idea here is to be precise because it's a volume game. And it is also important to react, I would say, in a pretty agile way, so that you're able to sort of counter the adverse conditions in the right frame of time. Apart from that, also in certain geographies, you will hear the term on-demand insurance products, especially on sharing platforms. We are seeing personal accidents, or for example, we have seen motor insurance for vehicle sharing operators that are actually demanding more precise and accurate calculation of premiums. And at the same time, in very selective geos, which are much more matured, we are looking at telematics and IoT, which are providing us more granular data sets for better analysis to provide more personalized products. So those are few examples where different markets with different maturities, different challenges are in the need of better, more precise, more accurate, and more agile pricing techniques where dynamic actuarial modeling play a role. And not to forget emerging risks. We have cyber risk, we talk about it a lot, right? which demands more AI-driven modeling to basically better quantify potential losses. And dynamic actuarial modeling would then probably enable people to incorporate those techniques in order to embed them into their pricing process.
Right. Okay. So, Stefan, can you describe the end-to-end actuarial process under the dynamic actuarial modeling, and how does that translate to more accuracy and compliance with regulations?
I think one of the things that the market really needs is to be able to go into a more refined way of getting prices up to potential customers. And that is probably only possible if you start to use more data, first of all, and also more the modern machine learning techniques, right? The old techniques, I would say, they will categorize very roughly. They will say young drivers are more dangerous than older drivers. Sports cars, when they're red, they're more dangerous than black sedans, for instance. But of course, that's generalizations. We might very well find young drivers who are very prudent and old drivers who drive like crazy, right? And it's only by being more refined that we can basically distinguish these pockets within the much larger groups that we have nowadays. Nowadays, we're modeling the average. We don't want to model the average anymore. We want to model the extremes. Mm-hmm. And that is using new techniques and using new data.
In general, how do you assess the point we're at right now? Is the industry more sophisticated or more basic in that regard?
It depends very much of the geography we're talking about, right? I think there are geographies where the cars come out of the factory with a telematics device already incorporated in the car, and so it's very easy to start gathering data on the behavior of the driver. There are geographies where such thing is either too expensive or too sparse to start using those techniques inside the models. But I have no doubt we are going to that kind of techniques, because as soon as a new market player would come on the market that has these techniques available and can drop the price for certain pockets of customers, the others will have to follow, right? Because if you're not sophisticated enough, you will lose your market share to the ones that can provide a more efficient pricing for those specific groups.
Makes sense. Very interesting. And Neil, let's talk about AI. In the context of AI-driven actuarial modeling, how enhanced governance and price execution capabilities, how would that help insurers make sure that they're pricing more accurately and more ethically?
Yeah, ethically is a very important question. I think we just talked about a lot on accuracy. Definitely, if you have better dimensions and more granular perspective of data, accuracy is normally going to be enhanced or improved. But let's talk about ethics. And imagine that we talked about that AI is going to bring in different dimensions and pricing factors that were previously not at play. And therefore, we need to be careful that those factors do not become very discriminatory. And therefore, you need to have proper governance that such biases can be excluded or ring-fenced. Imagine within a pricing factor, you bring in a dimension of race while trying to look at socioeconomic attributes. Is that a good way of going forward when you're trying to do a pricing for a particular product? Probably not. And these kind of areas probably need to be protected. I think that is why governance is a very important aspect when you're trying to use AI, and especially ethics becomes a very important point of consideration. Also, there are tactical aspects that we need to think about. For example, risk pooling still becomes very important. And if you completely forego the aspect of pooling, then you might automatically reject a certain subgroup of people for whom insurance does not become a prospect or become an interesting proposition. Mm-hmm. So those are, I think, aspects that we need to be careful about as much as AI can add value, that we do not completely compromise on the grounds of ethical and governance-based pricing models.
We'll continue to talk about AI, and now in a large question to you, Stefan, which I'll divide in two parts. The first is how dynamic actuarial modeling can improve the precision of risk assessment and premium setting given AI's capability to uncover very intricate data patterns and optimize model parameters?
Okay, that's a nice question. I would say that, again, it has to do with availability of data, right? So let's look at things which have to do with climate, for instance. A lot of the climate pricing depends on geo factors, right? Knowing where exactly are you. So, for instance, how far am I away from a river? How high am I if I'm away from the river? And in normal days of flooding, how high does the river come up? So, insurers use more and more these data sets to find out what a potential new flooding could mean to them, right? Because they know where their customers are sitting along a river, for instance. They know if a flooding comes, what is impacted geographically. And so they know basically also that they can sum up all of the customers that have been impacted by that. And that will, in the next time that such a customer wants to renew or wants to have a new policy, they will take that into account when they price them. Mm-hmm. So they can do it up to the level of individual houses, individual companies, sure. Not just all of the people in a certain area, but depending on how close am I to the river, how high am I compared to the river.
Right. So you're already starting to get closer to the next question, which is related to climate change. Mm-hmm. It's a big topic within the insurance industry. So tell us a little bit about how pricing modernization could help insurance companies in that, given that context.
Yeah, well, it goes into what I already answered, I think, but it also goes into what is the individual impact on every single person of climate, right? Mm-hmm. There are more things than flooding, of course. All of the catastrophic events might come up to a customer. And there again, it's important that you know, is there any chance my customer gets impacted because of the place where he lives, because of the circumstances he works in, for instance, because of the transportation roads he needs to take, right? Because it can very well be that I don't suffer in my house, I don't suffer in my workplace, but I suffer on the road going from one to the other. Mm-hmm. So it's all about data. Sure. Data, and then you can unleash the most modern techniques on that data, and we have them in our dynamic actuarial modeling. It's a set of models, in fact, that help you to model those things for the future.
It's all about data and real-time data, right? Because
as much
things
as possible.
Are changing so fast.
Exactly. So the things we did with that data 10 years ago isn't applicable anymore today.
Mm-hmm. Mm-hmm. Yeah, that makes sense. So for you now, Neil, just to close this conversation, tell us a little bit about what can we expect in terms of next developments in dynamic actuarial modeling?
Yeah, I think it opens up a lot of possibilities. In general, we have always talked about introduction of solutions to necessarily enhance the two very conventional aspects, whether it's effectiveness or efficiency. Solutions like dynamic actuarial modeling probably goes one step larger or even I would say one step ahead, where it sort of brings scope in consideration, that how pricing scope might change with the adaptation of tools and techniques and solutions like this. We have previously talked a lot about telematics and IoT, right? I mentioned that in my previous answer, that those provide you to go for more personalized products. Now, when you go for such products, obviously that also means that these opportunities sort of start coming up to you to tailor your products better, thereby beating the competition in many ways. You also try to sort of, with the similar techniques, lessen down your overhead of launching a product or maintaining a product in a certain segment. Let's take addressable market. When you're competing in a fixed market, in an addressable market that is already kind of given to you, especially for motor insurance, that you see that for every year when you're renewing your insurance, you have a lot of players probably offering you competitive policies.
Especially after open finance, right?
Correct. And at this moment in time, there are third parties which are taking advantage of your pricing policies, your pricing attributions, mm-hmm. giving you multiple choices. And solutions like this probably have a better role to play to have better introspection in addressable market, sometimes increasing the addressable market, where you felt your product is not going to be viable, but now being able to take a better judgment of what kind of tailoring can actually make that product more viable for that addressable market. The second thing is for a particular product where you thought there is no market for a certain segment, for a certain dimension of profile of people, you get better understanding of how to pitch that into those segments. So thereby opening up newer geos for the similar kind of products. And we have seen that in the banking space, for example, when it comes to investment, but now we're also seeing it in insurance space when it comes to different kinds of niche insurance policies being given to people to cover segments which previously we deemed, as I mentioned about, for example, the micro insurance aspect of things, which we previously didn't seem to be viable. So I believe that solutions like these have potentially a lot of areas that once people start adapting them, they will become clearer and clearer. It's very difficult to kind of give a very concrete, finite set of areas that will actually get enhanced because the potential for solutions that are AI enabled are pretty much infinite. But definitely these are the first 2 or 3 areas that we will see a change. Behavioral data patterns changing the way we look at penetrations. We will look at addressable market theories going under random changes by better introspection of data, and product viability for segments where we will have different dimensions to sort of look into, or risk factors to look into, where our products are going to play a bigger role.
That's really interesting. It's good for companies and also good for the consumers that they serve at the very end of the spectrum, right?
Correct.
Because on the third pillar, particularly that you mentioned, it contributes to personalization of products as well, doesn't it?
100%. And that is why I think the better fit for purpose will be determined when you're actually competing in certain geos where the competition is stiff and there is a requirement for such niche offering.
Excellent. Well, thank you very much, gents. I learned a lot about this process today, and I hope to be able to talk to you very soon.
Thank you.
It was a pleasure.
Thank you.
Look
Thank you.
forward.